Hello everyone, welcome to today's backtest. And today's backtest is going to be on US100, that's the Nasdaq CFD, and also we're going to be talking about the new week open gap and the new day open gap. We're also going to be talking about the price run and price movements for today's New York AM session. But first, I want you to get the understanding for the new week open gap and the new day open gap and how price makes use of them. So ICT have talked about this on his mentorship videos, I think 2023, that was when he talked about it. And also I've talked a bit about it on my previous videos as well. So firstly, the new day open gap, how does it come about? Okay, so for each trading day, the market closes on each trading day. Okay, there's a time on US100, Nasdaq, where the market closes. So there's a time where the market closes for each day, and there's a time where it reopens. Okay, now if your time zone is set to New York, your time zone should be set to New York so you can follow up with what I'm about to say. Just like mine. Mine is set to New York. So at this time zone, the market closes at 4:59 p.m. each day and reopens at 6 p.m. So there's a 1 hour time window where trading, where there is no trading activity going on. Okay, there is neither buying or selling at that particular time window. So from 5 p.m. to 5:59 p.m., there is no trading activity going on. Okay, that's the market close for each day. And during this time, since there is no trading activity going on at this particular time window, okay, it's like a 1 hour time window, there's a void created on the chart. Sometimes it's very visible and sometimes it's not that visible, but when you drop to the 1 minute time frame, you understand what I'm talking about. So that's for the new day open gap. Then the new week open gap, every week the market closes on Friday, same, still at 4:59. So at 4:59 p.m. on Friday, the market closes and it reopens at 6 p.m. on Sunday. So during that time window, that time range, okay, the market closes for the week and there is no trading activity. Also, a void is being formed at this particular time window, time range, where there is lack of trading activity going on. And this void space being created in price at this particular time ranges, price is going to refer to those levels. Okay, price is going to refer to those levels from time to time. And talking about resistance and support, these are like your real resistance and support, because price, it's like the algorithm in price is programmed to refer to these levels. And like I said earlier on my previous videos, they act as magnets, like a black hole, like they draw price. Things like a black hole which draws things to itself. Okay, that's the way the new day and the new week open gap act. They act like magnets to price. So price is drawn to them. So just as Michael Huddleston, ICT advised, I keep on my chart the last 5 recent new day highs formed in price and the last 5 new week open gap formed in price. So the most recent new day open gaps for the last 5 days is saved on my chart, and the most recent 5 weeks new week open gap are also saved on my chart, and I study how price makes use of them. Also, another interesting thing about the new day open gap and the new week open gap is that they are good reference points to to take partials from your trade or to take profits from your trade, which we are going to look at on this backtest video. So if you are setting up the price action of the buyers for that day, you can frame your new week open gap or your new day open gap as a level in price to take partial or to take profits from your trade or to close the trade. So going into today's backtest, by the way, this is my new week open gap and this is my new day open gap. You can see so the new week open gap is colored black and the new day open gap I color mine purple. And you can see this label, new week open gap high February 16th. Okay, this was the one formed for this week, and this is the new day open gap formed for Tuesday 17, which is today's date. Also, this is the high of the new week open gap, high. This is the low, new week open gap low. This is the high of the new day open gap, and this is the low of the new day open gap. And I'm going to drop to the 1 minute time frame and show you how this forms, starting with the new week open gap, which was formed on the 16th, February 16th. Now you can go into your charts and also do this. Start marking out your new week open gap and your new day open gap, and keep the last recent ones on your charts. That's about five of them. So 5 of them for the new week open gap, 5 of them for the new day open gap. Now on my charts, you can only spot one new week open gap and one new day open gap, right? Here's what I do. I normally save them on this object tree right here. You see, new week open gap, new day open gap. Here's my new week open gap. I normally save about 5 of them, but there are only 2 on my charts. Okay, they're up to 5. I think they're up to 5 on my new day open gap. But this is how I make use of the object tree. So I hide the ones price is not making use of currently. Okay, so my charts will be clean, because when you cluster your charts with new day open gap and new week open gaps, sometimes it will be very difficult to read price. Okay, an alternative would be to get another clean chart and draw your new week open gap and new day open gap at that chart separately from the charts where you normally analyze. But if you are going to do it like I do mine, okay, here's how I do it. So I normally hide the ones that are not currently in use, just like this. You can see some being hidden. Friday 13th low is hidden. Friday 13th high hidden. Thursday 12th high is hidden. And the one price is currently making use of, that's the Tuesday 17 low and Tuesday 17 high. So that's how I manage my charts, and that's how I keep my chart clean. Now going to how the new week open gap forms. Okay, now this is February 13th. Okay, and you can see at 4:59. Let me zoom. At 4:59, you see this candle, and you see this gap between this candle and this candle at the top. Okay, so during this time window, during this 1 hour time window, there was no trading activity. There was neither buying or selling. Okay, that was the market close. Okay, so the market closes at 4:59 and then reopens on Sunday at 6 p.m. It closes at 4:59 p.m. and on Friday and reopens at 6 p.m. on Sunday. So this happens every week. Okay, so every week there is always a new week open gap being formed after the market closes and reopens on Sunday. Now, after the market opens, the following day is Monday. The following trading day is Monday, right? And Monday is 16th. That's why my new week open gap is tagged new week open gap February 16th. Now going to the new day open gap. This is the one for the new day open gap. Now yesterday was Monday and yesterday was bank holiday, and the market closes earlier, okay, on bank holidays. So on Nasdaq, that's the real Nasdaq, the market closes at during bank holidays. It closes at 1 p.m. and reopens that same day at 6 p.m. That's for bank holidays. Then on the US100 and Nasdaq 100, the market closes at 3:59 on holidays, I guess on this holiday, and reopens at 6 p.m. So it closed at 3:59 p.m. and reopens at 6 p.m. Now, if there was no holiday, the market is going to close at 4:59, like I said, 4:59 p.m. and reopen at 6 p.m. Now, you can see the gap between the two candles. And this is how I draw the new week open gap and the new day open gap. Watch this. Look at this. Look at the top of the chart right here. This is your O stands for open, H stands for high, L stands for low, and C stands for close. Okay. Now watch this. So this is the candle at the bottom, right? And this right here is a candle formed at the top. Okay, that's why this is labeled new day open gap low, and that is labeled new day open gap high. Correct. Now you are going to draw your line at the close of this candle where the market closes. Okay, so what's the close of this candle? Just take your eyes to C at the top. See, that's 24,666. And you can see that's where this line was drawn. 24,666. Okay, now the line at the top, that's the new day open gap high, is going to be drawn at the open of this candle where the market opens. So what's the open of this candle? The open of this candle, look at this top, look at O, take your eyes to O, that's the open. The open of the candle is 24,694.3, and that's same level where this line was drawn. So that's how you get your lines correctly, and that's the same way you draw the new week open gap as well. So I will repeat this process so you get it. So this was the candle formed at the low, and this is the candle formed at the low, and this is the candle formed at the high, right? Now you draw your line at the close of this candle, okay, because this is the candle before the market closes. Then this is the candle when the market reopens. Then you draw another line at the open of this candle. Just so you understand this clearly, let's go to the new week open gap and see how the line is being drawn. Okay, the level is being drawn. Okay, now, okay, on the new week open gap, this was the candle before the market closes, and this up here is a candle after the market opens. All right, now this is the high. Okay, that's why it's labeled new week open gap high, and this is the low. That's why it's labeled new week open gap low. Now don't just watch this section of this back test video and ignore it. You should go to your charts and try to plot this on your chart as well, the new week open gap and the new day open gap. Start facing them on your charts, and you notice how price makes use of them. And also, like I said, to make your chart clean, you can make use of the object tree, or you can use a different chart from the one you use to backtest, analyze, or trade, to draw them out, and you see for yourself how price makes use of them while doing your backtest and while studying price. Now, I know I have taken a bit of time trying to explain this, but I just have to, because this video is mainly about the new week open gap and the new day open gap. We are going to get to price action, to the backtest for today. I just wanted to get the knowledge of the new week open gap and the new day open gap, not just knowing how price makes use of them. That's not enough. So you should know how to plot them on your charts, to draw them on your charts. That's why I'm taking my time to understand, to explain how it's being formed, how you can draw them, and how you can also label them. Now, this is the candle, okay, before the market closes. Now, you are going to draw your line at the close of this candle. Look at the top right here. Look at C. C is at 24,700.9, right? 24,700.9. Now, remember, this is US 100, okay? The figure is definitely going to be different from Nasdaq. This is also the same way you draw it on Nasdaq if you are using Nasdaq to trade. So the figure right here might be different from Nasdaq, but it's same process, it's the same way. The way you draw it here, the process at which you draw it here, that's the same way you draw it on your Nasdaq chart as well. And if you use ES 100, no, not ES. If you trade ES, you trade the S&P 500. That's the same process. That's the same way you draw it as well. So this doesn't just apply to US 100, Nasdaq 100, or Nasdaq. Okay, it's same thing for ES, for S&P 500. Now this is the low. What's the close of this candle? 24,700.9, and that's where this line was drawn. Just look at the line, 24,700.9, and the open of this candle, that's where your second line will be drawn, okay, because this is a candle formed after the market, when the market opens, okay, so it opens with this candle. That's 24, okay, the open of the candle. Look at O. O stands for open, 24,750.8, and that's where this line at the top was drawn. Now you know a few about the new week open gap, the new day open gap, how it's formed, the time where it's formed, and how to draw and tag or label the highs and the lows of it. Now let's go to the price action, the price run for today. Now this is the New York AM session for today, Tuesday 17th of February. This is 17. Let me get ready. Now, prior to 8:30 a.m. Remember, your time zone should be set at New York. Prior to 8:30, price ran down to take out this low right here. To grab sell side liquidity, right? And after taking out this low, you can see the displacement at which price gapped up, forming a fair value gap. It also took out this short-term high right here. So the short-term high was also taken while displacing upward and forming a fair value gap as well. So this is a 5-minute fair value gap, right? And exactly at 8:30, this is the 8:30 mark right here. Exactly at 8:30, you can see price dropping down into this fair value gap. After taking out this low, displacing upward, it runs down into the fair value gap exactly at 8:30 and consolidated, stayed there for a while. Then at 8:50, price displaced upward again. That's this candle right here, 8:50. Also, if you take note, this is an order block. Okay, you see the down close candle followed by this up close candle. Change the state of delivering price. And during these displacements, there was a very small fair value gap created in price. So the gap, the high of this candle's wick and the low of this candle's wick. And if you look upward, during this displacement upward, okay, price took out this high right here. And you can see another high to the left of it. Okay, so these are relative equal highs, okay, and buy stops are resting at the top of this high and this high. So during this displacement upward, price has traded above this high, though not through it completely with a wick, the candle's wick. Okay, price has traded through this high, but still price has not completely run up through this high and this high. Then after this gap up, this displacement upward, exactly at 9:30, price dropped down into this small fair value gap. Okay, this is 9:30 on the 5 minutes candle. Price dropped down into the small fair value gap. You can see how it trades up with speed to take out this high completely and finally this one. So these are buy side liquidity resting. They are buy side liquidity resting above these highs. Now you see the whole pictures. The whole picture. Price takes out this low, displays higher, created the fair value gap, trades into the fair value gap, displays higher one more time, takes out this low, this high with the wick of the candle, trades down into a smaller fair value gap, and then rally up with speed to take out this high right here. So if you were to be on this trade, let's say you're buying at this point, ideally your take profit is going to be maybe at this high, at this highs, or at this high. That's ideally. But if you notice above this buy side, you can see the new day open gap is just above this buy side, and the new week open gap is above the new day open gap. Okay, so the new day open gap and the new week open gap are just above this buy side. And on my previous video, I said something. I said if a new week open gap, a new day open gap, or a first presented fair value gap is above my take profit level or buy side liquidity while I'm buying, okay, I'm going to allow price a chance to see if it's going to trade into those levels. Most of the time, price do trades into those levels. Those levels, they are like reference points. Like I said, the new week open gap and the new day open gap, they act as black hole, like magnets in price. So price is drawn to them when moving in that direction. And you can see how it pierces through the buy side liquidity this high and trades through the new day open gap and into the new week open gap before this massive drop down in price. Now, how is that random? How is this random price piercing through the buy side, going through the new day open gap and stopping exactly at the new week open gap before dropping down? Doesn't that tell you price is algorithmic? And doesn't that tell you that this level is actually significant in price? These levels right here. And you see, after trading into it, it uses it as a resistance to bounce down. Okay, trades into this low, takes out the sell side from this low, and price is currently at this level, I think, consolidating. Now, okay, since you know about the new day open gap, the new week open gap, I know some of you already know about this. Some of you watch ICT concepts must have probably heard about the new week and the new day open gap. I'll be making more videos of this and how price runs to them. Now, do you need the new day open gap and the new week open gap to be profitable in price? Because setting your stop loss at this high is also not a bad trade. It's a very good trade. No, you don't. But it gives you more understanding of what price is doing. Okay, it gives you more understanding of what price is doing. Like there are some traders who we see this run up to this level as random and trading down. Okay, but if you have this level, you know why. Okay, price stops at this level, stopping at the new week open gap and dropping down. Like it gives you more clarity in price. And when you start drawing these levels on your charts and you see how price makes use of them, it's very fascinating. Now I'm going to be dropping to the 1 minute time frame, then you can call it a day. This is the 1 minute time frame. Now I'm going to take this off and this off. Okay, so on the 1 minute time frame, after price takes out the sell side liquidity from this low, rallies up. Okay, there are so many gaps formed, but I'm going to make you use of this one. Okay, now you see there's a volume imbalance at the top and at the bottom. Volume imbalance, the gap between the bodies of two different candles. So I'm going to make room for the volume imbalance by drawing this. So price trades above, okay, while price displays upward, it took out this short-term high, formed the fair value gap, trades into the fair value gap, and then gapped up one more time. Okay, trading up to this high right here, and also forming a fair value gap below at discounts. There's a volume imbalance at the top, so I have to make room for that. Now, for those who thinks the 1 minute time frame can't be understood or make use of by trading, okay, this is an example for you. Okay, so after this displacement upward, it formed this fair value gap was formed, and price traded into it at 9, and at 9:30 it trades into it one more time, and then you see the run up in price, the speed at which price runs up. This is that buy side, this green line, buy side liquidity. That's this high right here, and then it trades into the new day open gap and into the new week open gap. That was where it makes the U-turn downward. Okay, so I hope you found this insightful, and I know you did. If this has brought value to you, drop a like, subscribe, and share to those who may need it. So until next time, have a productive week.